Hey everybody, Signet here. I wanted to welcome you to the Bullish Bears Options Trading Series. So each blog in this series is going to focus on specific tasks and actionable criteria, strategic planning to pull the trigger on an options trade. And in this post, we're going to discuss selling out of the money options to make some money. How accurately can you determine market direction? Even when you get the market direction right, how accurately can you predict the distance of that directional move? When trading options, there are many ways to make money in the market. Why place money into a trade that requires a specific move to a specific price? When you place an options trade like this, you risk losing money if you get the direction wrong, and you risk losing money if the move doesn't reach your target profit zone. How about market sentiment? Let's talk about this for a minute and find some common ground. So, what is market sentiment? When I think of market sentiment, I think of bias and perspective. When you bring up a chart and you look at your favorite indicators, what feeling do you have? Was there a news article or a blog that causes you to feel mildly bullish or bearish? Is there some indication from your previous trading experience that gives you a hunch about where the market may go? That feeling is market sentiment. Did I lose you yet? Well, let's talk about markets then. When I say market sentiment, what market am I talking about? Equity markets? No, you're not going to hear me speak that finance geek talk. When I say markets, I'm referring to the entire market symbols that are tradable on the broker platform you use. Let me give you some examples. Suppose I say that the market is Apple. Now, Apple is a great example of market. I have a particular market sentiment on Apple stock and a completely different sentiment about the Apple company. SPY? Yes, even though SPY is not a company, it is still market. Futures? Absolutely. In these blog posts, market is any ticker symbol that can be bought or sold with your funds on your trading platform. So now that we've found a common definition of markets and we have defined what market sentiment is, how do we use that to make some money? Instead of specifically trading on direction and focusing our trade hitting a specific price target, I suggest we instead develop a trade plan that uses our market analysis, market sentiment, and directional bias to determine where price is most likely going to be in the near future and place a trade that avoids that price action. It sounds backwards, doesn't it? What's more likely, that we can determine the general trend of the stock and place a trade with a goal of avoiding price, or that we can determine exactly where price will be at a specific time in the near future? I think we can all agree that determining market direction based on trend analysis is a fairly easy task compared to determining exact price action in the future. We can even use market sentiment, bias, and chart analysis of support and resistance and price structure to help us determine trend. Suppose you're new and you cannot do support and resistance very well. Maybe you are new and you do not have a strong grasp of chart analysis or price structure. These types of strategies can be used by new traders who have access to the Bullish Bears chat rooms, the Bullish Bears watch lists, and the aftermarket subscription services like Black Box Stocks, Trade Ideas, or TrendSpider. Why? Because these types of trades rely on accurately determining market trend and momentum, and everything listed above is offered to assist you with exactly learning that. So let's get back to selling out of the money options. Okay, so You got to think all of this is just too easy, right? It's fairy tales or some sales trick. No. If you're reading this or you're watching the video, then you have already bought the only thing you need, a Bullish Bears community membership. Armed with that membership, you now have all the tools you need to start trading actionable strategies based off the data offered, while also having the free time needed to study, paper trade, and learn more about other trading concepts and techniques. So, what's an out-of-the-money option? An out-of-the-money option is an option with a strike price beyond the current price of the underlying. What? Finance geek, right? Here we go. What I meant to say is that a call option out of the money is above the current price, and a put option out of the money is below the current price. They are not in the money because they are beyond the price. If the price moves to the strike price of the option, they're no longer out of the money, and they are instead at the money. Now, why is this important? If we open an options trade by selling an out-of-the-money option to enter the trade, then to exit that trade later, we need to buy it back or let it expire worthless. If we sell a spread to open the trade in an option that only has time value, they will slowly decay and become worthless if price never comes to our sold option's strike price. Are you confused yet? Don't worry, we'll go through a few different examples to clear things up. Before we get into some examples, let me take a minute to ask you for a favor here. Forget all the classes or blogs or training sessions you've ever taken about options trading. Why? Because somewhere along the way, the training or the classes or the coaching sessions, they all led up to some hook. Somebody was trying to sell you something. Someone had an agenda. I want to ask you to set all that aside and focus on the basic concepts presented here. Look at the overall concept and accept it for the reality that it is. It's an example of a trading strategy. That's it. A discussion of what selling out of the money options means and how we can do it to produce consistent income with minimal risk. To be fair, I do have an agenda. I have a goal. My goal is to show you how to develop a trade plan, and my goal is to give you the tools to act on that plan. So in this chart of SPY, the short-term market trend is bullish, and I would look to place a trade below the direction of the market trend. With some basic moving averages of the 20 SMA, the 50 SMA, the 200 SMA, a stochastic slow indicator, and an RSI, I developed a short-term bullish bias. Price right now shows SPY to be at 277.37. Now, since SPY can move a good distance in a short period of time, I would look to place a trade with some distance below 277.37. Let's take a look at the options chain and pick a product. All right, so this looks like a lot of information to take in all at once. It's a good idea to take each section separately and get an understanding of what we're looking at. Starting at the top left is the last price of SPY. You can see it's 277.37. That was Friday at the close. Friday, SPY moved $2.99. That's quite a move for a stock in a day. All right. Now, with price at 277.37, we want to get an option below that price. The 274.50 option would be a good one to look at. Now, as you can see, this option is $3 away from the current price, and it is in the opposite direction of the current trend. If we took that option as our trade, we could collect $30 by selling this put. If you look to the lower left, you can see the probability of profit. Now, this isn't the probability of max profit. It's only the probability that this trade could make 1 penny or more before expiration. In this SPY example, this trade has a 94% probability of profit. Sure sounds good to me. Moving across the bottom, we can see that our max profit is $30. And our max loss is $27,420. Let's take a look at this max loss for a moment. Selling a naked option carries undefined risk. So what does that mean? It means that you're on the hook for the promise made when you enter into this trade. What's the promise? You're promising to buy this option back in the future at whatever price it might be. If SPY suddenly tanked in a black swan event and fell $200, the price of this put would be beyond my calculation. The broker suggests that the max price of this put in a black swan event is $27,420. Now, is that a likely situation? No. Can it happen? Sure. I do not take anything off the table when it comes to market events. Sure, it can happen. You can also win a $1 million lottery ticket with a scratch. Is that likely? No, but it is possible. So let's recap what we've covered this far. We can take our market bias of current directional trend and develop a trade based on this directional bias. We would want to enter a trade out of the money and beyond the direction of the current trend to avoid being run over. We sell an option to enter the trade, and we buy that option back to exit the position. Since an option out of the money only has time value, we want to sell it and let that time decay. Reduce the option's value to zero. Why? Because if we have to buy it back to close this trade, we want to spend as little as possible. In this SPY example, the option we looked at was $30. If I sold that option for $30 and I must buy it back to close my position, well, I want to buy it back for less money than I sold it. I would rather buy my position back when it's $0, when it's worthless. Have you identified where we may have an issue in placing this trade? Yeah, the max loss. The max loss would keep me out of this trade because I trade with a small account, far less than $27,000. The idea is still a great idea, selling an option that only has time value and then letting the clock decay the price of the option until it expires worthless. We just need to develop a trade that eliminates this undefined risk. Now, how do we do that? Well, we just buy another option. I know, right? That sounds even more confusing. You thought we were selling options, right? Well, that is the plan. But we also need to protect our backside. Well, our downside. And we do this by buying an option. So let's look at an example. So here I've added an option to cap our loss or define our risk. Since we must buy an option to accomplish this, it reduces the amount of money we would receive from the sale of the first option. In this example, there's not a lot of time value left in these options, so there's not a lot of money to really be made. Once we factor in commission fees, this trade would not offer us very much profit. But this isn't the point of the example, however. The point was to demonstrate how we could sell an out-of-the-money option and make a profit by allowing time to decay the value of that option. This example was to show how we can use a spread to define our risk and protect our account from a black swan event. By walking through the example, we were able to take the trade in pieces, understanding why each part of the trade was taken. First, we develop a market bias and determine trend. Second, we look at the options table to determine what money the option would generate. Third, we find an option to protect our downside and define our risk. That's it. So in this example, our max loss is now $280. Because we had to buy an option to define our risk, our max profit is now only $20. But we still have a probability of profit of 93%. Let's look at another example. Let's find an example with some more time value. So here we have a $5 wide spread that could be sold for a max profit of $71. The probability of profit is 76%. The expected move, $4.72. And the max loss is defined at $429. This strategy is not restricted to only selling puts in a bullish market, though. We can place the same strategy with call options in a bearish market. How? Well, let's look at an example. Here, we have an options trade in Apple. This is a bearish position that looks to avoid getting in front of trend momentum by building a spread above the price of Apple. This $10 option spread has a max profit of $159 and a max loss of $841. The probability of profit is 70%, and the current price of Apple is $170.42. Now let's take a moment to discuss this max loss in more detail. I understand that this trade looks skewed if you have not sold options before. The risk-reward ratio seems heavily one-sided, right? Who would risk $480 to make $160? I would. The probability of profit and the fact that I can close the position early means that I not only have a better than 50% chance of making money, it also means that if price begins to move in my direction, I have a lot of time to exit this position or adjust this position. The only way I would take the entire max loss is if I placed this trade and I never looked back. Who would do that? So let's recap. Selling options out of the money is a strategy that takes advantage of market trend and momentum. We want to avoid getting run over by price action, and so we enter a trade behind the price action. This strategy does not participate in the price move, which means if the price moves 10 cents or $10, we will still make the same amount as long as price follows the market trend from our analysis. You now should have a very solid understanding of what selling out of the money options mean, and you should know how to build the spread. This is not the end of the discussion. There is a lot more detail we need to cover to give our trades a greater chance of success, and we need to discuss different ways to adjust this trade if price starts to move against us. And we will discuss these things in the following blog post. We will cover choosing the strike prices, the Greeks, and everything else I mentioned above. I look forward to seeing you there. Thanks for watching the video.